Insurance Commissioner Dennis Funa, PIRA Chairman Edgardo Rosario, NATRE CEO Alan Santos, IAP officers, fellow speakers, delegates, ladies and gentlemen, good morning. PLIA extends its appreciation to IAAP as the summit's organizer for giving us the opportunity to present updates from the life insurance sector. I would like to start this presentation by showing how the industry has progressed in its recovery path, especially with respect to our performance compared to pre-pandemic levels, in order to respond to the question, are we there yet? Let's first have a look at the Philippine economy. GDP in 2021 grew by 5.7%, which led NEDA Director General Carl Chua to predict then that we will surpass pre-pandemic growth levels in 2022. True enough, Q1 2022 GDP expanded by 8.3%, which reflected a big turnaround from the 3.8% contraction in the same period last year, and a counterpart pre-pandemic growth rates of 5.6% in Q1 2019 and 6.5% in Q1 2018. While the answer to the question is a clear yes, we are there already concerning the economy, it is not quite there yet in the case of the life insurance industry if we go by the 6 key metrics we use as gauge. As shown on the slide, we have already recovered to pre-pandemic levels in the areas of premium income, net income, assets and investments, but remain on a catch-up mode in NBAPE or new business APE and net worth. Let us have a look in more detail. We see here that we have achieved normalized output levels against 2019 pre-pandemic period by overtaking premium income by 33%, assets by 16%, investments by 15%, and net income by 8%. It is comforting to see that these areas realize consistent growth across the 2 comparison years, and that growth over 2020 did not merely come from the low base effect of impacted performance during the height of the pandemic. This slide aims to see how some premium income attributes played into the strong total premium income performance over the last 2 years. We see that consistent renewal premium growth in both product lines and across the 3 comparison periods worked favorably for the industry. The reduced surrender rate and the over 1% increase in lapse rate in 2020 reflect the conflicting influences of the pandemic. On the one hand, recognition of the importance of having continued coverage at a time of heightened vulnerability to health and life risk would have prevailed over thought of surrendering a policy. On the other hand, dire pandemic-induced circumstances would have led to discontinued payment of due premiums redirected for emergency purposes, thus giving rise to increase in lapse rate. The good thing is that the increase in lapse rate did not come at a degree so as to negatively impact flow of renewal premiums. On the flip side, new business APE and net worth remain areas of concern as growth recovery levels still fall short of 2019 pre-pandemic numbers, being 9% and 5% behind, respectively. The intermittent conduct of in-person agent examinations brought about by restrictions from the frequently changing quarantine declarations has been impacting the inflow of new agents and consequently new business APE. The online agent examination facility as it is can currently accommodate only 150 examinees per day. Growing net worth has proven difficult owing to the interplay of reduced revenue from lower sales volume and investment returns, along with essentially status quo operating cost levels topped with additional expenses from mandatory health and safety protocols in the workplace. Looking at the industry situation on a company level, we see that more than half of the market players suffered a decline in their premium income in 2020 during the height of the pandemic. We then see this number improving to just 20% of companies not realizing growth in 2021, though when compared to their pre-pandemic levels in 2019, 40% remained unable to reach performance normalization. The same pattern seen in the premium income performance was carried over to the new business APE output. Adverse impact of the pandemic was highly evident in 2020 when 79% of companies incurred decline in new business premium production. The situation improved in 2021 with only 41% having no growth, but still at 60% when compared to 2019. New business APE is an area requiring doubling of efforts to achieve full recovery. In this regard, we view the country's low-risk COVID status could work for the industry as the public may now be more open to parting with their funds to acquire insurance rather than saving them for potential emergency use. For this part of the presentation, I will present performance numbers based on data from the industry's top 10 premium income performers in 2021, which accounted for 82% of our aggregate output. Given that official numbers from the Insurance Commission may be available by August yet, since 2022 Q1 company financial reporting deadline had been extended to June 30. The performance from this group will serve as a good indicator of what to expect from the industry. Let us see how it looks. We see here that the potential reversal of growth trends in Q1 2022 between new business APE and the premium income. If these indicators shown by the top 10 companies hold for the whole industry, we are looking at the possibility of new business APE maintaining its growth pattern, though modest at the vicinity of 0.24%, while premium income would likely suffer a decline of about 7%. In order to offset this likely premium income decline, the rest of the 21 companies would have to grow their Q1 2022 levels by 33%, which would just bring the industry to break-even status. That would be quite a big challenge. The following slide shows 3 key areas of focus where the industry is putting its attention in the hope of creating more impetus to growth. First is increasing agent licensing output through a robust online qualifying testing facility whose capacity is responsive to the demand from the industry. We understand that manpower resource limitation in online proctoring currently holds back the expansion of this capacity in this regard. PLIA has offered to help the IC in looking at a technological solution to such limitation via an artificial intelligence assistant testing platform. We are awaiting IC's official blessing for PLIA to pursue this initiative. Second is looking at securitization as an investment strategy. The benefit of this approach is enabling a new source of finance for the significant and growing demands of the infrastructure marketplace, and at the same time, providing high-quality fixed income securities that support the long-term investment objectives of insurance fund managers. PLIA is closely working with the IC in developing the implementing guidelines on asset-backed securities, which the industry hopes will serve as our pathway to long-desired infrastructure financing participation. Third is the effort to amend the insurance code in order to put the brakes on the 1.3 billion mandated minimum net worth by the end of this year and freeze it to the present requirement of 900 million pesos. This came in the form of Senate Bill 2144 filed in the concluded 18th Congress, a joint initiative between PLIA and PIRA. This did not push through though, but will be refiled and earnestly pursued in the incoming 19th Congress. At stands at the end of 2021, attaining 1.3 billion net worth is still a work in progress for 12 life companies at varying degrees, as you can see from the slide. The smallest deficit within this group amounts to 75 million or 6%, and the biggest at 488 million or 38%. It is the industry's view that proceeding with a 1.3 billion level would make us disproportionately overcapitalized relative to our market size as compared with our ASEAN counterparts. Funds that would otherwise be used to build up to such minimum net worth level may instead be used for financing digital transformation initiatives which had been made imperative by the pandemic. This will redound to the mutual benefit of the players as well as the insuring public. I am closing this presentation with a brief discussion on our ESG compliance aspiration. The difficulties that the local industry is facing with regard to embracing ESG principles and practices were surfaced last year through a survey conducted by the ASEAN Insurance Council for its October 2021 meeting. The survey revealed that PLIA members ranked the issue besetting them as follows. First, insufficient liquid green assets to match liabilities of sustainable insurance products. Second, insufficient demand for sustainable insurance products. Third, lack of expertise to design sustainable insurance products. Fourth, lack of expertise to assess green assets to match liabilities of sustainable insurance products. Both internal and external obstacles hinder transition to sustainable insurance. It does not help that as a country, the Philippines is reported to lag behind Southeast Asian peers in terms of green transition and climate ambition, based on the latest report of Massachusetts-based global management consultancy Bain & Company. Given where we are now, we endeavor for more of our market players to deliberately take steps toward ESG activation in their operations. While multinational companies are leading the way in this respect, owing to being driven and guided by the regional or global offices, local players are not able to follow suit as quickly due to lack of technical resources to support developing strategic moves toward compliance. It would do well for the industry to work closely with the Insurance Commission and ESG advocate organizations in enabling access to international expertise in this area. The regulator being able to offer incentives for market players to take the leap to ESG compliance would also help boost the drive. The industry looks forward to creating a progressive ESG foothold in our operating landscape in the years ahead. I trust that the foregoing presentation provided you an appreciation of the current state of the life insurance industry. With the pandemic situation continuing to get better, the economy being well tracked toward full pre-pandemic recovery, and the heavily impacted business sectors getting back on their feet, we believe that we would like to make the Philippines a better place in our continuing pursuit to provide financial protection to as many Filipinos as possible. It is my pleasure to being with you in this event. Thank you and have a good day.